You already know the feeling. Markets are climbing, your portfolio looks great, everyone around you seems to be making money, and yet something in the back of your mind keeps whispering that this cannot last forever. The problem is, that voice shows up every single year. And if you listen to it too early, you miss out on years of gains. But if you ignore it too long, you get crushed. So what do smart investors actually do? How do they prepare without panicking, without sitting on the sidelines for a decade, and without falling into the same traps that have destroyed wealth since before the stock market even existed? That is exactly what we're going to break down today. The warning signs that show up before every major crash, why most people miss them, and the practical steps you can take right now to protect and grow your money no matter what comes next. Stay with me, because by the end of this, you are going to see the market very differently. Here is something that trips people up constantly. The fear of a crash makes them do nothing, and doing nothing has its own massive cost. If you have been sitting on the sidelines thinking the market is too high, too risky, too unpredictable, you are not alone. Millions of investors have felt that exact same way for years while the market kept climbing. The truth is, waiting for the perfect moment is its own form of loss. Missing 10 years of compounding growth because of fear is just as damaging as taking a hit in a downturn. So the answer is not to avoid the market. The answer is to understand it well enough to stay in it smartly. Now let us talk about the patterns, because here is what history actually shows us. Crashes are not random. They are not lightning bolts from a clear sky. They build slowly, quietly, and they always leave behind the same fingerprints. Every single major financial collapse, from the Dutch tulip mania in the 1600s, to the railroad collapse of the 1870s, to the Great Depression, to the 1997 Asian currency crisis, to the 2008 housing disaster, shared common threads that were visible in advance if you knew what to look for. The first pattern is speculative overconfidence. When prices keep rising, people stop asking whether something is worth what they are paying for it. They just assume someone else will pay more tomorrow. We saw it with tulip bulbs selling for more than a house. We saw it with railroad stocks priced on pure optimism. We saw it in 2007 when Chinese retail investors were picking stocks based on lucky numbers. The asset changes every cycle. The psychology never does. When you start hearing that this time is genuinely different, that is your signal to pay close attention. The second pattern is debt-fueled growth. Almost every major crash in history had leverage hiding underneath it. The 1929 crash was supercharged by margin loans, where everyday people were borrowing 90% of a stock's value just to buy more stock. The 2008 crisis was built on layered debt products that almost nobody understood. Today, household credit card balances are near record highs. And this is worth addressing directly because rising consumer debt is not just a number on a chart. For many working families, it reflects real financial pressure. Wages have not kept pace with the cost of living, and credit has become a coping mechanism, not a choice. That distinction matters. When we talk about debt as a warning sign, we are not pointing fingers at individuals. We are pointing at a structural problem that makes the whole system more fragile. The third pattern is innovation that outpaces understanding. Every boom era produces financial products that feel revolutionary but carry risks that nobody fully grasps until it is too late. In 1929, it was leveraged investment trusts. In the 2000s, it was mortgage-backed securities. Today, it is algorithmic trading, AI-driven portfolios, tokenized assets, and buy now, pay later platforms that are being used for everyday groceries. Speed and complexity in finance are not bad by themselves, but when everyday investors are handed tools they do not understand, and when regulation has not caught up, that is a setup we have seen before. The fourth pattern is regulatory blind spots. Before the Great Depression, there were almost no safeguards on leveraged investing. Before the 2008 crisis, subprime lending exploded in a space that regulators were either ignoring or were too slow to act on. History has shown repeatedly that when financial innovation races ahead of oversight, the fallout hits everyone, not just the people who took the most risk. The fifth pattern is herd behavior and fragile capital flows. The 1997 Asian financial crisis is a perfect example. Foreign capital flooded into Southeast Asian economies, everyone chased the same story, and the moment confidence cracked, the exits got impossibly crowded. Currencies collapsed, savings disappeared, and entire middle classes were wiped out in months. Herd behavior is not stupidity. It is human nature. We are wired to follow the crowd, especially when the crowd appears to be winning. But markets driven by momentum rather than fundamentals can reverse just as fast as they rise. And here is the part that frustrates so many people. You can recognize all of these patterns and still feel like you cannot time it correctly. That frustration is valid, and it points to one of the most important lessons in investing history. Timing the market is extremely difficult, even for professionals. The goal of understanding these patterns is not to predict the exact day the next correction begins. It is to position yourself so that when it happens, you are not destroyed by it, and you are ready to take advantage of it. So what do smart investors actually do? First, they stay grounded in value. If you cannot explain what you are buying and why it is worth what you are paying, slow down. Chasing price momentum without understanding fundamentals is how people get caught holding the bag. Second, they maintain liquidity. Having cash or low-risk reserves on the side is not a sign that you're missing out. It is dry powder. When prices drop, and they always eventually do, liquidity is what lets you buy while everyone else is selling in panic. Third, they play the long game deliberately. The investors who have consistently built wealth across multiple market cycles are not the ones who called every top and bottom. They are the ones who stayed invested in quality assets through volatility and did not let short-term fear override long-term strategy. Fourth, they tune out the noise. Market headlines are designed to trigger emotional reactions. Every policy announcement, every dramatic speech, every crisis cycle produces noise that can make you feel like you need to act immediately. Most of the time, you do not. The investors who win over decades are the ones who act on research and strategy, not headlines. Here's the bottom line. Crashes are part of the cycle. They always have been, and they always will be. Every economic expansion contains the seeds of the next contraction. That is not pessimism. That is just how cycles work. The question is never whether a correction will come. The question is whether you will be prepared when it does. Understanding these 5 patterns, overconfidence, excessive debt, misunderstood innovation, regulatory gaps, and herd fragility, gives you a framework that applies across every market era, not to predict the future, but to navigate it with a lot more clarity and a lot less panic. Here's what I want you to think about and share in the comments below. Looking at these 5 historical patterns, which one do you think is the biggest risk in today's market, and why? Drop your answer below. I would love to hear how you are thinking about this, because the conversation in the comments is always one of the most valuable parts of this community. If you found something useful in this video or learned something new, please hit the like button. It genuinely helps this content reach more people who need it. And if you want to keep building your investing knowledge, subscribe and ring the bell so you never miss the latest insights. More videos are coming, and you do not want to fall behind. See you in the next one.